last few years, I've been fortunate enough to build up a property portfolio that is in its double digits. And it's during this period that I've had to develop my own knowledge and navigate through a whole host of challenges and mistakes. But the reality is, if I can do it, then so can you. This Property Market Investor Expert series has been created so that you can learn from the mistakes which might otherwise be made along your journey, and open up your knowledge to identify investing opportunities which you may have otherwise not even been aware of. Today, I'll be meeting with Scott Brunsdon, who is the co-founder and co-director of Depreciator, a leading depreciation schedule specialist for property investors. So what is it that Scott does to help investors become successful with their investing journeys? Scott helps his clients take advantage of potential tax benefits within their portfolio. This can potentially assist an investor with tens of thousands of dollars of additional cash flow each year, a benefit which any serious investor shouldn't do without. Let's find out from Scott more about what he does. Hey Scott, how's it going?
Good, Ryan.
So for those potentially not in the know, what is a depreciation schedule?
Well, it's probably a good idea to back up a few steps and look at what depreciation is.
Yeah.
So depreciation is compensation for wear and tear on an asset.
Yeah.
And businesses depreciate their trucks and their computers and their furniture. And if you've got an investment property, you've got a business. So you can claim depreciation on your asset. Your asset is not a truck or a computer, your asset is a property.
Yeah, indeed.
So you can claim compensation for wear and tear on that property. And there's compensation on the building itself, the walls and the roof and the floor. And there's compensation on the assets in it, which are things like the stove and the carpet, the curtains and the range hood. So depreciation is simply a property investor claiming compensation for wear and tear on their investment.
And are all property investors, in your opinion, aware of this? So is there a certain proportion of investors that maybe don't take advantage of this opportunity?
It breaks our heart, Ryan. There are lots of people not aware of it.
Yeah.
When we started our business about 16 years ago.
Yeah.
16 years ago, a lot of people had no idea about depreciation.
Yeah,
that
okay.
knowledge is changing. It is growing because of things like this and because of property investing books and podcasts and radio programs and all that sort of stuff. So the knowledge is increasing. But there are still lots of people that don't claim depreciation. And they tend to be people who are perhaps in their 40s or 50s and they've bought their first rental property.
Yeah.
And it's a property in the suburb they live in and they've always done their own tax. They've always had very simple tax structure. Yeah. They've always done their own tax. They buy a property, it's no big deal, so they claim their outgoings and keep doing their own tax. The thing they don't claim is depreciation, and they don't claim it because nobody tells them about it.
So and it's just leaving money on the table, right?
Yeah. It's terrible. It makes us very sad. What we find is often those people, they may pick up a second property, or their tax situation might become more complex.
Yeah.
So they go to an accountant and they sit down with the accountant and say, look, we've always done our own tax, but now we need your help.
Yeah, okay.
And they tell the accountant what they've been doing, and the accountant looks at their past returns that they've done themselves and says, what about depreciation? You haven't claimed depreciation. And they say, what? Nobody told us. So because we get so much of our work from accountants, we regularly get accountants sending clients to us who have owned a property for 3 or 4 years and never claimed depreciation.
Yeah, okay.
And in those cases, it's very easy for us to do a depreciation schedule starting 3 or 4 years ago.
Yeah.
And the accountant goes back and amends previous tax returns.
I see.
And picks up that lost money.
How far into the past are you allowed to? Is there a cap on how far back you can go to claim?
There is. And the ATO used to let people amend 4 previous tax returns.
Yeah.
Now they've changed it, and you're allowed to go back and amend 2 very easily. And the reason for that is that nobody ever seeks to amend a tax return if they think they owe the ATO more money.
Yeah.
So the only reason you go back and amend a 3-year-old tax return is if you think there's something in it for you.
So
the ATO
reducing the claims.
They've made it more difficult.
Okay.
It is possible to go back further.
Yeah.
But an accountant needs to almost seek permission to go back further.
Yeah.
But it is very easy to amend 2 tax returns. From our perspective, from a depreciation schedule perspective, we can start a depreciation schedule 20 years ago or 15 years ago, it makes no difference to us.
Yeah.
But if we start one 10 years ago, and the client's tax returns are up to date, they may not be able to go back 10 years and claim that depreciation back that far.
Yeah, okay. So it sounds as then for the most part it's investors right at the beginning of their journey that are for the most part not aware of this as being an opportunity, and then maybe the more established investors that have the multiple properties, they're the ones that are actually taking advantage of it.
Yeah, I think people with multiple properties are more inclined to seek guidance.
Yeah.
And because things get more complicated.
Yeah.
So they'll seek guidance from an accountant, they'll join groups, they'll seek guidance from mentors.
Yeah.
And those sort of people, accountants and groups and mentors, will alert property investors to things that they may be missing out on, like depreciation. So
for sure.
When investors join the investing community, if you like, that's when they hear about tax breaks that, you know, a lot of people miss out on.
Yeah, indeed. Is there maybe any parts of property investing that wouldn't be so suited to depreciation schedules? So maybe looking at renovations or developments or commercial. What is suitable and what's not suitable?
There's depreciation in practically everything.
Yeah.
There's an important date, which is September 1987.
Yeah.
Depreciation was introduced in 1985 at a certain rate, and then it was dropped back in 87. But basically any building, so let's talk about residential. Any residential property where construction started after September 87, that building can be depreciated.
Okay.
And it depreciates at 2.5% for 40 years from when it was built. So if a residential property was built in 1990, that building depreciates until 2030.
And this is based on the build price?
Just the
building?
The build cost at the time it was constructed.
How do you go back and establish what the building costs to
well, that's what we do.
Okay, so that is your job to reverse engineer it.
So we have a network of quantity surveyors.
Yeah.
And typically what we do is a client will call up and they'll say, look, I've got this 15-year-old property.
Yeah.
We will send a quantity surveyor to the property.
Yep.
The quantity surveyor needs to get inside the property and work out how much it costs to build that property 15 years ago.
Yeah. Okay.
So that's the way it works. And the other thing to bear in mind is that although there's a cut-off of 87 for residential, some commercial is prior to that, but if a client owns an old property, a 100-year-old property, and a previous owner has done a substantial renovation, that new owner can depreciate that renovation. Which is fantastic.
Okay. So it's not just the actual original building, it's any structural renovation?
Structural renovations.
It has to be structural rather than cosmetic.
Yeah, it's more structural. And that's something that a lot of people don't know about.
Yeah.
And even a lot of accountants don't know about it, because when somebody goes to their accountant to do their tax return and says, look, I've got this rental property, and the accountant might say, how old is the property? And they'll say, oh, look, it was built in 1920.
Yeah.
And the accountant will say, well, not much in that from a depreciation perspective.
Indeed.
Let it go.
Yeah.
But, you know, I don't think there are many 1920 built properties that have not been renovated.
Too right.
And in the capital cities, in those inner ring properties in the capital cities that are old, and many of them have been renovated, it's hard to do a decent renovation for less than $80,000.
Oh, for sure, yeah. So
and if you're talking in the last 5 years, it's going to be more than that. And a typical renovation is kitchen, bathroom, second bathroom, open up the back, put a deck in, a rumpus room or something. That's a typical renovation of an old established property. And if that was done by a previous owner 6 years ago, and a new owner buys that property to rent out, that new owner depreciates the renovation. And from our perspective, it's no different from us walking into a 15-year-old house. We walk into that 1920s house and we have to estimate what that renovation cost to do 15 years ago.
Yeah.
And then we put a value on it and it goes from there.
It's exactly the same. I don't know if you remember, but I mean, we of course work together. I've got quite a few depreciation schedules with you, and I went through exactly the same scenario with my property in Prospect in Launceston.
Okay. Yep.
So I think that maybe it's a 1960s build. I purchased that for $450, and on face value, I wasn't too confident that there would be much depreciation available within it, but it was actually yourself or one of the Depreciator team members that flagged with me, you know what, there's been a significant renovation that has occurred here. We're actually going to be able to claim a lot more than we first anticipated. So it was through actually reaching out to yourself that I was able to really take advantage of that, and that means that for the next, I don't know, maybe 20 years that I'm going to, from a cash flow perspective, be able to take advantage of that.
Yeah, and we often send quantity surveyors to properties, and they spot renovations that the client didn't know about.
Yeah.
I mean, we're constantly surprised. I'm not saying this about you, but we're constantly surprised at the fact that clients will buy a property and they'll call us up and they'll say, "Have they had any renovations?" And I'll say, "I don't know." They have no idea. And accountants, their accountant would have no idea because their accountant hasn't even seen the property.
Indeed, yeah.
So we suggest to people that they send us photographs. And everybody has photographs of the property they've just bought or the one that they're thinking about buying.
Yeah, or from the rental manager.
Or from the rental manager.
The rental inspection.
Or from the sales listing online. There's photographs there. And we can look at those photographs very quickly and tell somebody how much depreciation might be in that property just based on those photographs. Because we don't want to do a depreciation schedule for somebody if it doesn't stack up.
Yeah.
That would be stupid.
Yeah, indeed.
They'll get disappointed.
Yeah.
It just creates unnecessary situations. So
in that circumstance, would you go back to the investor and say, look, it's probably not worth it?
Yeah, absolutely. Every day of the week. Every day of the week, we say to people, look, to be honest, there really isn't enough depreciation in this property to justify our fee. I mean, we have a guarantee. Yeah. We're the first company to have a guarantee.
And what is that guarantee?
And now everybody's copied it. The guarantee is that, on a post-87 build, we'll find more than double our fee in depreciation in the first full year.
Yeah.
So it's a no-brainer. It's a guarantee. But having said that, although we have that guarantee, I don't think we've had to pay out on that guarantee in years and years and years, because we don't want to take on a job, send a quantity surveyor to a property, disturb a tenant, do a depreciation schedule, look at the figures and say, that's disappointing. Yeah. We'll have to refund this client their money. We would much rather decide before we go through the hoops if it's worth doing the job and say to the client, look, to be honest, there isn't enough in this to justify our fee.
Yeah, and it's tax deductible as well.
Yeah, our fee's 100% tax deductible. Yeah, okay. And the document we produce runs for 20 years. Yeah. It's not something that people have to pay every year, much to our disappointment. Yeah. So it's a one-off fee that runs for 20 years. Okay. And, we're a little bit unlike other companies also in that when people change their property, update their property, we update the depreciation schedule for no charge.
So that's it. For example, I were to do a renovation?
Yeah. Okay. Yeah, if somebody, and this is very typical, we have people that come back to us before tax time every single year. Yeah. And they say, well, in the last year, I had to put a new hot water heater in. Okay. I put it in on this date, this is what I spent, and we update their depreciation schedule and send it out. And then we have people that say, look, I had to do a bathroom renovation, here is what I spent, this is the date I finished that renovation, and we update their schedule.
I see, yeah. So how was it that you actually first got into the industry? Was you an accountant originally, perhaps?
No. I mean, my background's marketing.
Yeah.
That's where I spend a lot of time, marketing and advertising. Yeah. And I was sort of an accidental property investor. Okay. I guess I did a fabulous renovation on a house in Sydney.
And was this a principal place of residence?
It was, and it was a renovation that took me 7 years. Wow. I did it myself and I enjoyed it. It was a fabulous journey and I met lots of.
So it wasn't a financial objective attached to the renovation?
No, it was a labour of love that took a long time, and I did that renovation. And then when I'd finished the renovation, my wife and I realised that the property was a bit too nice for us to live in, and we wanted more space. Yeah. She wanted a studio, she's an artist, and I wanted a shed to make things, and that property didn't suit that. So we started to look for a bigger property with more land in Sydney.
What suburb was this original property in?
It was in Annandale.
Annandale, okay.
Yeah. Cool. Fabulous property after the renovation.
Yeah,
In a great part of Sydney.
Yeah.
But Annandale houses are typically small, on small blocks of land. So we went a little bit further out, not that far, and found a huge house.
Yeah.
And the price was fabulous.
Yeah.
And we realised that we could buy that and keep the Annandale property.
I see. So it wasn't your initial intention to retain it.
Not at all.
But was it? And how did you realise that? Did you speak to the bank directly? Or
Yeah,
did you
no. I
liaise with a
spoke
mortgage
to the
broker?
bank. I spoke to the bank.
Okay.
And they, I said, look, we want to buy this property.
Yeah.
And this was in the late 90s.
Yeah.
And I looked at the figures, and I said to the bank, I said, so I could keep that other one and buy this one. And they said, yeah, you could do that. So that's why I sort of say that I'm an accidental investor.
I see. Yeah.
Because I kept and partly I kept the old one.
Yeah.
Because having done a beautiful renovation, it was very hard to part with it.
So you're emotionally invested by this.
Emotionally invested, which is of course the wrong thing to do.
Yeah.
But I was emotionally invested, so I wanted to keep that old property.
I see.
And then we moved into a different property.
And did you leverage potentially the equity created within the renovation to use as the deposit for the new principal place of residence?
Yes. And the bank worked that out.
Yeah.
The bank, we had a very good bank manager or loans manager or something.
Yeah.
Who I still talk to. I still haven't seen.
Great. So you never used a mortgage broker then? It's all been direct?
No, which I probably shouldn't say. But I've only ever dealt with this one guy at the bank. Yeah. For over 20 years.
Okay.
Great. And he's done things for me that have been fantastic and given me advice. Yeah. So he's the one who said, look, I said, do you reckon I can keep that other property? He said, yeah, I think so. He said, let's do it this way. Let's do things this way. Yeah. And then you keep that and rent it out, and then you buy this one. And I was using an accountant, and this was the late 90s. Yeah. And the accountant said to me, okay, you need to get a depreciation schedule. Okay, right. And
so once again, it's the accountant that actually brought to your attention the fact that this is
George, the accountant. I said, what are you talking about, George? And he sort of explained it, and I didn't understand it. Yeah. And he said, look, just do it because it makes sense. And I remember engaging a guy, and it cost me $1,000.
$1,000? And this is going back.
This is 1997.
Okay.
$1,000 for a depreciation schedule. And they're much less than that now.
And was this guy who was completing it for you, was he specialised in depreciation schedules?
He was a quantity surveyor.
Because accountants can do it as well, can't they?
No, if accountants have all the costs, anybody, if somebody knows, if somebody has all the costs,
the original cost,
if somebody knows what a house costs to build, if somebody knows what the oven is worth and the cups, so anybody can take those costs and apply the ATO rules to those costs.
Yeah, indeed.
And claim depreciation. Yeah. What an accountant can't do, and what an ordinary investor can't do, is walk into a 10-year-old house and say, well, I think 10 years ago this house would have cost $216,000 to build. Yeah, indeed. And they couldn't walk into a renovation and say, well, I think this renovation would have cost this much. Yeah. So we engaged a quantity surveyor. Yeah. For $1,000.
Still hurts, doesn't it? I can see it.
And he came in and he looked at the works. Yeah. And he put together a depreciation schedule that I then gave to the accountant. Yeah. And when I do my tax every year, the accountant would claim this thing called depreciation. So he would claim mortgage payments, council rates, water rates, property management fees, repairs, but also this thing called depreciation. Yeah. And I think 20 years ago, as an ordinary investor, I was quite rare in having a depreciation schedule, rare in having an accountant who knew
that it was available.
That it was worth doing.
Why was there such a lack of education around that being available to investors?
Look, I don't know. I think the problem is that mums and dads didn't know about it because there wasn't the education. Yeah. From an accountant's perspective, if an accountant said you need a depreciation schedule, their client would say, well, how do I get that? Yeah. And the accountant would have said, well, you'll need to find a quantity surveyor. Now, the problem is that a lot of quantity surveyors don't do tax work. That's not what they're trained to do.
Yeah, they may be focused on new developments.
No, not really. I'm a quantity surveyor. if you're going to do a building, if you're going to build something,
Yeah.
you might get some plans drawn up, and you'll go to a quantity surveyor and say, how much will it cost to build this building? And then a quantity surveyor might do a bill of quantities, and they'll work out what materials you need to build the thing, and they'll say, well, it's going to cost this much to build that property. And then a quantity surveyor will in part, assist in monitoring the build as it happens.
Yeah.
So that's what they do. They work with quantities and estimating quantities. They're not trained in tax. So for them to learn tax, it's something extra they've got to do.
And potentially, was it small fry to them in comparison to these larger projects?
Small fry. Yeah. So accountants had no solution.
Yeah.
So I think a lot of accountants didn't talk about depreciation because they had no solution. So we started our business about 16, 17 years ago. And when we started to go to accountants and say, hey, we think you should do this, we can offer you a depreciation schedule service.
Yeah.
A lot of those accountants said, fantastic, thank God. We've been waiting for someone like you to come along.
Yeah.
And a lot of those accountants we spoke to 17 years ago still use us to this day. Those firms still use us for their depreciation schedules.
So was that your initial rollout plan then, to get those strategic partners in the accountants for them to advise and almost educate, not directly the investors, but through their accountants? Through the accountants. That now there's a source available in which to get the depreciation schedules organised.
Yeah, the idea for the business, Hans Dean, he came up with the idea for the business.
Yeah, and Hans Dean, is he your co-founder?
Yes. Yeah. But he's the driving force.
Yeah.
And he's the majority owner. And it was his idea.
Yeah.
And he was in a seminar, property seminar.
Okay. Yeah. What year was this?
This would have been probably, I don't know, 2002 or something.
Ah, right. Okay.
And in that property seminar, and it was a Peter Spann seminar.
Yeah.
And he was doing the rounds, and he talked about this thing called depreciation. And somebody said, well, how do I do that? And he said, you need to find a quantity surveyor. And Hans at that stage knew some quantity surveyors.
Yeah.
So he had the idea to start up his business doing depreciation schedules. And we'd known each other. And he got in touch with me and he said, look, I want to start this business doing these things. I said, what are you talking about? And we met up and he explained it. And I said, okay, we'll give that a go. And then we, of course, looked at how we get our business.
Yeah.
And we thought going to accountants would be a great way to get business.
Yeah, indeed.
So that's what we've always done. And we get most of our work from accountants.
Yeah, okay.
So that was 17 years ago. I came up with the name Depreciator, which is a fantastic name.
There we go, good domain to have.
It's gold.
Yeah, yeah.
Our competitors hate the fact that we have that name.
So there were some major changes which occurred in 2017.
Yep.
Would you be able to outline for our investor audience what they were and how it might impact them?
So basically, there was a decision made by the Treasury in 2017 to fiddle with the rules around depreciation. Now they have fiddled with the rules previously, and it's never retrospective. It only affects things going forward.
Yeah.
So nobody needs to panic about changes being applied retrospectively.
Yeah, indeed.
What they wanted to do was limit the depreciation of second-hand assets. So let's take, for example, a stove in a house, in a residential property. Now, if an investor bought that property 10 years ago and started depreciating that stove, and then a second owner bought the property and they depreciated that stove again, and then a third owner bought the property and they depreciated the stove again, that same stove was being revalued and depreciated by multiple subsequent
for the
owners.
whole life of the stove?
Well, it would sometimes go beyond that.
Yeah, okay.
So what Treasury thought was that this was a little bit, not a rort, but they sort of felt that an asset really shouldn't be able to be depreciated multiple times.
Why does that change then? So they're the fixtures and fittings, right? And like a stove maybe falls into that category. Why is it different for the actual building? Because potentially investors, there's four sets of investors depreciating a lot.
There are. But what happens is the building depreciates at a flat rate of 2.5%.
Yeah.
2.5% per year for 40 years.
Yeah.
So if somebody buys it new and rents it out for 5 years, they claim that for 5 years.
Yeah.
Then the next person buys it, and they claim their time.
Yeah.
With assets, it's a little bit different because assets can be depreciated more rapidly. and there is a chance for an asset to be depreciated a couple of times more than its true value.
Yeah, I see.
So they wanted to stop that. So all they did was, and it really didn't have a massive impact, what they did was they said, okay, if you buy a second-hand property, you can still depreciate the building.
Yeah.
We're not going to touch that. You can still depreciate any structural renovations. What you cannot do is depreciate a second-hand stove.
Okay.
But the depreciation that you would have been able to claim under the old rules, you record that, and if you sell the property, that unclaimed depreciation is treated as a capital loss to reduce your capital gains tax.
Yeah.
So the depreciation is still there,
Yeah.
you just can't claim it till down the track. So we introduced a new product called a Deferred Depreciation Schedule,
Yeah.
which is another brilliant idea, brilliant name. And what that does is that records the depreciation that people would have been able to claim,
Yeah.
and tells them when they sell the property how much they can treat as a capital loss.
I see.
But it doesn't affect, and if somebody owns a property and puts a brand new stove in, brand new carpet, brand new blinds, they depreciate that. It doesn't affect that.
Yeah, for sure.
It doesn't affect brand new property. If somebody buys a brand new property, they depreciate the building and the assets. There's even a 6-month window. If somebody buys a brand new property and a developer has had a tenant there for 5 months,
Yeah.
although those assets are used, it's under that 6-month window.
So the next,
So the new
they start it from the beginning.
the purchaser who buys that property can still depreciate the assets. Those assets are treated as brand new, even though
see.
they might be 5 months old and being used.
And so outside of residential, does the same rules apply for the commercial industry?
No, the changes that came through in 2017 did not affect commercial property.
Why is that? Why is it treated differently?
I don't know, but the government decided to only touch residential property.
Yeah.
So what we have seen with our client base is we have seen a bit of a shift to commercial, second-hand commercial. So we've seen probably more clients buying offices in strata buildings to rent out, small factory units, shops, because those second-hand properties, the assets in those are not affected by the changes.
Okay.
But even the effect has been fairly minimal. I think it was sort of was blown out of all proportion, I think.
Yeah, okay, lovely stuff. Well, you've certainly given us food for thought. Thank you so much. If people wish to get in contact with Depreciator, how should they go about that?
Phone. We've got a website, of course.
Yeah.
Which is depreciator.com.au, but we have a 1300 number.
Yeah.
It's 1300 660033, and we're a little bit different from a lot of other companies in that the people that answer that phone in our office in Sydney are pretty well trained and they're pretty knowledgeable, so people don't get past to 3 or 4 people before they can find somebody sensible.
Yeah, okay.
They'll often find sensible answers to questions in that initial phone call.
Okay, sounds good. Well, thank you so much for your time.
It's my pleasure. Thanks, Ryan.